You ever notice how so many traders spend years chasing the perfect strategy, thinking that if they just find the right combination of indicators, patterns, or secret formulas, they'll finally crack the code? I've been there, and I'll tell you something straight. Strategy alone won't make you profitable, not even close. The truth is, in trading, discipline always beats strategy. You can have the most brilliant system in the world, but if you can't stick to it, if you let fear, greed, or impatience dictate your actions, you'll never see consistent results. Discipline is the foundation, the backbone, the difference between a trader who survives and one who burns out. And most people don't realize how hard it is to master because they're obsessed with trying to outsmart the market instead of mastering themselves. When I first started trading, I made the same mistake that almost every beginner makes. I thought that finding the perfect strategy was the key to success. I spent hours analyzing charts, studying patterns, testing indicators, and backtesting models, convinced that if I could just uncover the secret formula, I would be unstoppable. And for a while, that belief gave me confidence. I felt like I was in control, like I had an edge that others didn't. But it didn't take long for me to realize something crucial. Strategy alone doesn't make you profitable. You can have the most brilliant system in the world, but if you don't have the discipline to follow it consistently, it's meaningless. Discipline is what separates traders who survive from those who fail, and it always comes before results. Discipline isn't just about following a set of rules. It's about controlling the impulses that make you deviate from those rules. Fear, greed, and impatience will show up whether you like it or not, and they will test you at every turn. Early on, I would take a trade that fit my plan perfectly, only to exit too soon because I was afraid the market would turn against me, or I would add to a position impulsively because I was greedy and wanted to maximize a win. Even though my strategy was solid, my lack of discipline erased any advantage it could have given me. The market doesn't reward cleverness if your actions are inconsistent. Execution matters far more than the idea behind the trade, and that's where discipline comes in. What makes discipline so powerful is that it creates consistency. In trading, consistency is more important than brilliance because the market doesn't care about one-off successes. A single trade that wins doesn't make you profitable, just like a single trade that loses doesn't make you a failure. It's the repeated application of a well-defined process that generates long-term results. Discipline is what allows you to execute the same process trade after trade, even when it's uncomfortable, even when the market is volatile, and even when emotions are high. Without it, even the smartest strategy is reduced to luck, and luck is unreliable. I've watched traders with exceptional intellect and creativity fail simply because they couldn't follow their own rules. They would discover patterns, develop strategies, and even see the potential edge in the market, but their emotions constantly overrode their decisions. They would panic after a small loss, chase trades impulsively, or abandon their plan when it seemed too slow or boring. Those who succeed, on the other hand, understand that discipline isn't optional. It's the backbone of everything. It allows you to survive losses, stay patient, and apply your system methodically, so that over time your edge becomes real and measurable. Discipline also gives you freedom. That might sound counterintuitive, but the more disciplined you are, the less reactive you become. You don't have to be constantly worried about the next price move or obsessing over whether you made the right call. You know you have a process and you trust yourself to follow it. That trust removes a lot of the stress and emotional chaos that traps so many traders. Strategy alone cannot give you that freedom. Only discipline can. It's what allows you to navigate volatility calmly and make decisions from a place of control rather than panic. And here's the key: discipline compounds over time. Each trade you execute correctly reinforces the habit. Each time you resist an emotional impulse, you strengthen your mental framework. Over months and years, those small decisions build a foundation that turns. Trading from a roller coaster of emotions into a skill you can rely on. Strategy is just a tool. Discipline is the engine that drives it. Without discipline, your strategy will fail you, no matter how brilliant it is. And that's why I've learned to focus on building habits and consistency first. When most traders start out, They believe that having a brilliant strategy is the key to success. But the truth is that strategy without discipline is like having a race car without brakes. You can go fast for a short distance, you can make some impressive moves, and you might even win a few races by luck, but eventually the lack of control will catch up with you. I've seen this countless times in my own experience and in the people around me. Traders obsess over indicators, patterns, and backtesting, thinking that if they just find the perfect combination, profits will come naturally. What they don't realize is that it's the consistent application of a plan guided by discipline that turns strategy into real results. Discipline in trading is not about blindly following rules. It's about building the self-control to execute your plan under pressure. The market is unpredictable, and it will test you in ways that no textbook or model can prepare you for. There will be days when your system is perfectly aligned with the market, yet a sudden move, a streak of losses, or unexpected volatility will tempt you to act impulsively. Fear will push you to exit too early. Greed will push you to take positions that don't fit your plan. Impatience will push you to chase trades before the setup is ready. If you don't have the discipline to resist those impulses, your strategy, no matter how brilliant, will fail. I remember early in my career, thinking that I just needed to figure out the right formula. I spent hours testing patterns, running simulations, and perfecting every detail of my approach. For a brief moment, I felt invincible, as though I had unlocked the code to the market. But reality hit fast. One small deviation, one lapse in judgment, and the results I expected disappeared. It wasn't the strategy that was flawed, it was my execution. I hadn't yet learned that discipline is the framework that allows strategy to work consistently. Without it, even the smartest plan is unreliable, because emotions and impulses will always find a way to interfere. Consistency is where discipline shows its true power. A strategy might be profitable on paper, but if you only follow it sporadically, or if you make emotional adjustments during critical moments, you will never see consistent results. Discipline allows you to apply the same rules trade after trade, creating a predictable pattern of behavior that the market can't exploit. Over time, this consistency compounds. A disciplined trader doesn't rely on luck or intuition, they rely on process. Every correct execution builds confidence, reinforces good habits, and reduces the impact of random outcomes. Another reason discipline beats strategy is that it keeps you calm under pressure. When the market moves against you or when unexpected losses pile up, a disciplined trader doesn't panic. They follow their risk management rules, stick to their position sizing, and execute their plan without letting fear or frustration dictate their actions. Strategy alone cannot provide that emotional stability. Without discipline, even a well-designed system can be ruined by a moment of panic or overconfidence. Discipline ensures that your strategy is implemented the way it was intended, no matter what happens in the market. Discipline also allows you to learn from mistakes. The market will always challenge you, and errors are inevitable. But a disciplined trader doesn't let a loss derail their thinking. They analyze what went wrong, adjust their process if necessary, and move forward without letting ego or frustration interfere. Over time, this creates a feedback loop where execution improves, strategies are refined, and results become more consistent. A trader without discipline, on the other hand, reacts emotionally, abandons their plan, and misses the opportunity to grow. Ultimately, the lesson is clear. Strategy is important, but discipline is essential. It turns theory into practice, ideas into results, and potential into performance. The best traders aren't necessarily those with the most brilliant strategies. They're the ones who can follow their plan consistently, manage their emotions, and stay disciplined even when the market is unpredictable. Discipline is the engine that makes strategy work, and without it, even the smartest plan is just a fragile hope. One of the most critical aspects of trading that many people overlook is emotional control. When I first started, I thought trading was all about numbers, charts, and patterns. But I quickly realized that the biggest challenge wasn't the market, it was myself. Fear, greed, impatience, and overconfidence are constantly waiting to influence every decision you make. And if you let them, they can destroy even the most brilliant strategy. Emotional control isn't about suppressing feelings or pretending you don't care about profits and losses. It's about recognizing your emotions, understanding how they influence your behavior, and preventing them from dictating your decisions. That skill is what separates the traders who survive from those who fail. In the beginning, every loss feels like a personal failure, and every win feels like proof of your genius. You take each trade personally, letting your ego ride on the outcomes, and that mindset is dangerous. The market doesn't care about your feelings, and it doesn't reward your ego. It simply moves according to its own rules, and your job is to respond appropriately. Emotional control allows you to separate yourself from the immediate outcomes and make decisions based on process, not impulse. When you can do that consistently, you start to see trading not as a test of intelligence or luck, but as a skill to be executed systematically. Fear is one of the most powerful emotions you'll encounter. It makes you hesitate, second guess, and sometimes avoid trades that fit your plan perfectly. It can also make you exit winners too early because you're afraid of giving back profits, or it can make you hold on to losing positions too long because you can't accept a loss. Without emotional control, fear becomes a constant barrier, clouding your judgment and preventing you from executing your strategy properly. Discipline helps to contain fear by giving you a framework to follow, rules to rely on, and a sense of predictability in an unpredictable market. Greed is equally dangerous. Early wins can inflate your confidence and convince you that you're unstoppable, leading to overtrading, excessive risk, or deviations from your plan. Greed pushes you to chase more than the system allows and tempts you to ignore your rules in pursuit of bigger gains. A disciplined trader recognizes greed as a signal to tighten control, to focus on process rather than outcome, and to stick to the strategy that works over the long term. That balance between ambition and restraint is what allows consistent profitability. Impatience is another emotional trap. You want instant results, immediate confirmation, and quick profits. When the market doesn't cooperate, it's tempting to take action prematurely, to jump into trades that aren't set up, or to abandon your system entirely. Emotional control teaches you to wait for the right setups, trust your process, and accept that profitable trading is a long-term endeavor. Without patience, even the best strategies fail because they rely on proper execution over time. Emotional control also allows you to learn from mistakes. Every trader makes errors, but what separates successful traders is their ability to analyze those mistakes without letting frustration, shame, or anger take over. When you control your emotions, you can see losses as information rather than judgment. You can objectively evaluate what went wrong, adjust your approach, and continue executing your plan with clarity and confidence. Traders who lack emotional control, on the other hand, often react impulsively to mistakes, abandoning their strategy and compounding losses. Ultimately, emotional control is what turns intelligence into results. A brilliant strategy is useless without the ability to execute it calmly and consistently. When you can manage fear, greed, and impatience, you create the mental space to follow your rules, stick to your process, and act from a place of clarity rather than chaos. Emotional control is the bridge between having an edge and realizing that edge in the real world. It allows you to survive the inevitable volatility, to maintain perspective during losses, and to capture opportunities without being swayed by emotion. The market is relentless, but traders who master their emotions gain a reliability and consistency that becomes their true competitive advantage. One of the hardest lessons I learned in trading is that the market doesn't care about your intelligence, your predictions, or even how brilliant your strategy is. The market responds to behavior, and most of the time, the behavior that matters most is your own. Emotional control is what separates traders who survive from those who fail. Yet so many people underestimate just how much their emotions influence every decision they make. Fear, greed, impatience, and overconfidence are always present, waiting for the right moment to take control of your actions. And without conscious effort, they almost always do. Emotional control isn't about pretending you don't feel anything or that you're immune to losses and wins. It's about recognizing what you feel, understanding how it affects your choices, and ensuring that it doesn't override your plan. Early in my career, I learned the hard way how emotions could sabotage even the most calculated trade. I would enter a position that fit all my rules perfectly, and then the market would move against me for a while, and suddenly I'd panic. I would exit too early, missing the setup I had anticipated, or sometimes I'd double down out of desperation, thinking that I could force the market to turn in my favor. Even when my strategy was sound, my lack of emotional control destroyed the expected outcome. That experience taught me that the ability to execute calmly and consistently is far more important than being right on any single trade. Discipline and emotional control are the engines that turn strategy into results. Fear is probably the most obvious enemy. It shows up in many ways: hesitation, second-guessing, or avoidance of trades that fit your rules. Fear makes you exit winners too soon because you're worried about losing profit, and it makes you hold on to losers too long because you can't accept a loss. Left unchecked, fear can completely derail your trading plan. But with emotional control, fear becomes a signal rather than a barrier. It tells you to check yourself, to confirm that you are following the rules, and to trust your system. Fear doesn't disappear, but you can learn to operate in its presence, turning it from a paralyzing force into a guide for measured action. Greed is another powerful emotion that can destroy discipline. Early successes can inflate your ego, tempting you to overtrade or risk more than your plan allows. Greed makes you chase trades that don't fit your setup and convince you that you're smarter than the market. A disciplined trader recognizes greed as a warning to double down on rules, to stick to the system, and to remember that long-term gains are more valuable than short-term thrills. The key is not to eliminate ambition, but to manage it so that it doesn't interfere with consistent execution. Impatience is equally dangerous. Many traders want instant results, quick confirmation that they're right, and fast profits. When the market doesn't provide that immediate feedback, they force action, jump into trades prematurely, or abandon their strategy entirely. Emotional control teaches patience. It allows you to wait for the setups that truly meet your criteria and to trust that your process will deliver over time. The ability to stay patient while observing the market is a major advantage that most beginners fail to develop, and it often determines whether someone survives or quits. Emotional control also transforms mistakes into opportunities. Losses are inevitable in trading, but a trader who controls their emotions can analyze mistakes objectively. Instead of reacting impulsively or letting frustration dictate the next move, you can identify what went wrong, adjust your process, and improve execution. Traders without emotional control often compound losses because they respond emotionally, abandoning strategy and chasing quick fixes, which usually leads to bigger mistakes. Ultimately, emotional control is the bridge between intelligence and results. You can have the best strategy in the world, but without the ability to execute it calmly and consistently, it is useless. Mastering emotions allows you to follow rules, manage risk, stay consistent, and operate from clarity rather than panic. It is the foundation upon which every profitable trading career is built, giving you the resilience to endure volatility, the patience to wait for setups, and the discipline to turn a plan into long-term success. One of the hardest lessons I learned in trading is that discipline is not just about following rules when everything is going smoothly. It's about following them when the market is against you. Early on, I thought discipline meant executing trades when conditions were ideal, when setups aligned perfectly, and when confidence was high. But real discipline is tested in moments of uncertainty, during losses, and when your emotions are screaming at you to act differently. Those are the moments when most traders fail because they let fear, greed, or frustration override their system. The ability to maintain discipline during adversity is what separates profitable traders from those who burn out and quit. I remember a time when I had a strategy that I had tested extensively, and on paper, it looked nearly foolproof. The patterns were clear, the rules were simple, and I could see the potential for consistent profits. But as soon as I started applying it in the real market, losses came. Not huge losses at first, but enough to trigger self-doubt. I found myself questioning my system, thinking maybe the market had changed or that I had misunderstood the signals. Those are the exact moments when discipline matters most. It's easy to follow rules when everything is going your way. The real test is sticking to them when the outcome is uncertain, when your account is fluctuating, and when the emotional pressure is at its peak. Discipline under pressure requires trust. You have to trust the system you've built, and more importantly, You have to trust yourself to execute it consistently. Without that trust, every loss feels like a personal failure and every deviation from the plan feels justified. But profitable traders learn to see losses not as judgment, but as part of the process. They understand that no strategy works every time and that even the best setups will sometimes produce losses. The key is not to react emotionally, but to stick to the plan, manage risk, and allow the process to play out over time. That level of patience and consistency is what turns a good strategy into a profitable one. Another element of discipline is controlling impulses. The market is designed to provoke emotional reactions, sudden spikes, unexpected reversals, and volatile swings all push you toward instinctive decisions. Early in my career, I would feel compelled to exit trades prematurely, chase setups that didn't fit my criteria, or over-leverage positions when a streak of wins made me feel invincible. Each of those impulses undermined my process and destroyed the reliability of my strategy. Over time, I learned that recognizing these impulses and adhering to my rules, even in the face of discomfort, was far more valuable than any single profitable trade. Discipline also allows you to learn and improve. When you execute a strategy consistently, the results reflect the actual performance of the system rather than randomness or emotion. This gives you clear data to analyze and refine your approach. Traders who abandon their plan during volatility or let their emotions dictate action never get an accurate picture of their strategy's strengths and weaknesses. By contrast, disciplined traders can measure performance objectively, make calculated adjustments, and improve over time. That's the difference between temporary luck and sustainable success. I also realize that discipline compounds. Every time I follow my rules, despite fear, greed, or frustration, I strengthen my ability to act methodically in the future. It becomes a habit, and habits are what define long-term performance in trading. Discipline doesn't just protect your account from mistakes, it builds confidence, reduces emotional stress, and allows you to operate with clarity under pressure. The market will always be unpredictable, but disciplined execution creates a foundation that allows you to survive losses, capitalize on opportunities, and steadily grow your edge over time. Ultimately, the lesson is clear: discipline is not optional, and it's not just about following rules when it's easy. It's about maintaining control, patience, and consistency when it's hardest. Without it, even the best strategy will fail because emotional impulses will always find a way to interfere. Discipline transforms potential into results, chaos into clarity, and strategy into sustainable profitability. One of the most critical insights I gained in trading is that consistency beats brilliance every single time. When I first started, I thought that success came from making perfect predictions or finding the one strategy that would always work. I spent countless hours analyzing data, testing patterns, and trying to outsmart the market. And for brief periods, it felt like I had the edge. I would hit a streak of wins, feel invincible, and think that my skill alone could guarantee continued success. But the reality quickly set in. Brilliance without consistency is fleeting. No matter how clever your strategy, if you can't execute it reliably, it won't produce results over time. Consistency is the engine that transforms potential into real, measurable profit. Consistency in trading isn't glamorous. It's not the excitement of catching a perfect swing or predicting a sudden market move. It's the day-to-day execution of a process, the repeated application of rules, and the ability to follow a plan regardless of how the market feels in the moment. It's what separates professional traders from hobbyists who rely on luck or gut instinct. You can have the smartest strategy, but if you deviate from it when the market is volatile, if you let fear or greed drive your decisions, you undermine any potential advantage. Over time, those small deviations accumulate, eroding your edge, and you are left wondering why the brilliant system you designed isn't working. I remember early in my career having a system that worked beautifully on paper. The setups were clean, the probability of success seemed high, and I was confident I had uncovered something special, but when I applied it in real time, my results were inconsistent. Some days I executed perfectly, and others I let emotions interfere. I would take profits too early out of fear, or chase trades impulsively out of greed. What I realized is that the system itself wasn't failing, it was my lack of consistency. My performance wasn't a reflection of the strategy, it was a reflection of my ability to stick to the plan every single time. That lesson changed the way I approached trading completely. Consistency compounds over time. In the same way, disciplined execution compounds profits. Each trade you take according to your rules reinforces habits that make future execution easier. Every time you follow your plan despite emotional pressure, you strengthen your ability to repeat that process in the future. Over months and years, these repeated actions accumulate into a level of reliability that becomes a true advantage in the market. In contrast, a trader who relies on sporadic brilliance or reacts impulsively may have occasional success, but they are exposed to far greater risk and will struggle to survive long term. Another aspect of consistency is its relationship with risk management. Trading isn't about hitting every win, it's about managing losses, protecting capital, and executing trades in a controlled manner. When you're consistent, your risk parameters are enforced automatically. You don't take positions that are too large, you don't overtrade, and you don't let a bad day derail your judgment. Consistency allows you to operate with a level of control that makes the randomness of the market manageable. Without it, even a good system can be wiped out by one impulsive decision. Consistency also creates clarity. When you follow your system reliably, the results you get reflect the true effectiveness of your approach. You can analyze outcomes, identify patterns, and make informed adjustments. Without consistent execution, it's impossible to know whether failures are due to flaws in the strategy or flaws in how it was applied. That clarity is critical because it allows learning and improvement to occur. A trader who acts inconsistently never develops that insight and remains trapped in cycles of frustration. Ultimately, the lesson is simple. Brilliance alone is not enough. What matters most in trading is the repeated, methodical execution of a plan with discipline, control, and reliability. Consistency transforms skill into results, chaos into predictability, and potential into long-term success. It is the foundation upon which profitable trading is built, and without it, even the most ingenious strategy will never be realized in practice. One of the lessons that took me the longest to internalize is that discipline compounds over time. And this compounding effect is far more powerful than any short-term advantage a strategy might give you. When I first started trading, I was obsessed with finding the perfect setup or the ideal formula that would deliver instant results. I thought that success was a matter of figuring out the right combination of data points and indicators, and that if I just got it right once, it would carry me forward. But the market taught me very quickly that nothing works that way. The advantage in trading comes not from a single brilliant trade or even a string of lucky wins. It comes from repeatedly applying a disciplined process day after day, month after month, year after year. Compounding discipline, in the same way that money compounds with consistent investing, builds a framework for long-term success. Discipline compounds because every time you follow your rules under pressure, you reinforce the habits that allow you to act rationally in the next trade. Each disciplined decision strengthens your ability to resist fear, greed, and impatience. Each time you adhere to your risk management parameters, despite market volatility, you reinforce a mental structure that makes future compliance easier. Over time, these repeated behaviors don't just protect your account, they shape your mindset, creating a trader who can operate calmly and methodically, even in the most unpredictable conditions. Early on, I didn't appreciate how much this internal development mattered. I thought that the right strategy alone would be enough, but I soon learned that a brilliant plan, executed inconsistently, is worth far less than a good plan, executed consistently with discipline. Compounding discipline also creates clarity. When you follow your rules consistently, your results reflect the true performance of your strategy rather than the noise of impulsive actions or emotional reactions. This allows you to objectively analyze outcomes, identify strengths and weaknesses, and make calculated adjustments. Without consistency, every result is a mix of your system and your impulses, and it becomes nearly impossible to know whether a change in approach is necessary. By compounding discipline, you build a feedback loop where each disciplined trade informs better decisions in the future, gradually improving both performance and confidence. I remember early in my career making small mistakes that I thought were inconsequential at the time. I would sometimes exit a trade too early out of fear or add to a losing position out of greed. Each decision seemed minor, but over weeks and months, those lapses accumulated, eroding the effectiveness of my strategy and creating frustration. What I realized is that discipline, when compounded, acts like a protective force. Small, consistent actions following rules, managing risk, and controlling impulses multiply over time, creating a margin of safety and a foundation for consistent results. Conversely, small lapses in discipline also compound, often with destructive consequences, which is why mastering this skill early is so critical. Another way to understand the power of compounding discipline is to think about it in terms of resilience. The market is unpredictable, and even the best systems will experience losses and periods of drawdown. A disciplined trader has the mental fortitude to survive these periods because each previous act of disciplined execution strengthens the ability to endure adversity. It becomes easier to stick to your plan, manage losses, and maintain perspective because you've built a framework of self-control that has been reinforced repeatedly. Over time, this cumulative effect creates a level of reliability and emotional stability that cannot be bought or learned in a single session. Ultimately, the lesson is that discipline is not a one-time effort. It's a skill that grows and strengthens with repeated practice. The traders who succeed are not necessarily the most brilliant or intuitive. They are the ones who have compounded discipline over time, who have consistently applied rules, controlled their emotions, and executed their plans under pressure. This compounding effect turns process into habit, habit into resilience, and resilience into long-term profitability. In trading, as in life, the power of compounding is often invisible at first, but its impact is profound and enduring. One of the most critical realizations I had as a trader is that a strategy is only as good as the engine that drives it, and the engine is discipline. Early in my career, I believed that success would come from uncovering perfect system, one that could predict market movements with precision. I spent countless hours testing patterns, running simulations, and refining ideas, convinced that if I could just crack the code, consistent profits would follow naturally. I was wrong. What I eventually learned is that a strategy is just a blueprint it shows you what to do under ideal conditions, but it doesn't execute itself. Without the discipline to follow the blueprint, the most brilliant plan will fail, and that's the lesson that separates casual traders from professionals. Discipline is what transforms potential into performance. You can design a strategy with incredible statistical advantage, but if you deviate from it due to fear, greed, or impatience, the advantage disappears. I've seen talented traders with seemingly perfect systems lose everything because they let emotions dictate their actions. They take trades impulsively, exit too early, or ignore risk parameters because the market moved differently than they expected. That's why discipline is the engine. It ensures that your strategy is applied consistently without interference from emotional impulses and allows the edge embedded in the system to produce tangible results. One of the key aspects of discipline is its ability to create consistency. A strategy can only be evaluated accurately when it's executed consistently. If you follow your plan sometimes and improvise at other times, your results are unreliable, and it's impossible to determine what works and what doesn't. I learned early on that the data from my own trades was only meaningful when I executed my system faithfully. Consistent application of rules produces clarity, and clarity allows improvement. Discipline doesn't just make your strategy work, it turns the market into a feedback system where each trade teaches you something about your approach, your risk management, and your decision-making process. Another dimension of discipline is emotional control. Markets are unpredictable, and even the best strategies experience losses. Without discipline, fear and frustration can override rational decision-making, leading to mistakes that compound quickly. Discipline allows you to stick to your plan, even when the market is volatile, ensuring that temporary setbacks don't derail your long-term performance. It also curbs overconfidence when trades go well, preventing you from taking unnecessary risks or abandoning your rules. Over time, this balance of patience and control strengthens the engine up. Execution, allowing your strategy to perform consistently over months and years. Discipline also enforces risk management. Even a strong strategy will fail without proper controls on position sizing, stop-loss levels, and exposure. Early in my career, I learned the hard way that ignoring these parameters, even slightly, could destroy gains quickly. Discipline ensures that risk management is applied systematically so that no single trade or losing streak can jeopardize the entire portfolio. It's the safeguard that allows a strategy to survive over time, and without it, even a highly probable system becomes vulnerable to catastrophic losses. Finally, discipline compounds like interest over time. Each disciplined trade reinforces habits, mental frameworks, and decision-making processes that make executing the next trade easier and more reliable. Conversely, each lapse in discipline compounds mistakes and increases vulnerability. That compounding effect is why professional traders often outperform those who rely solely on intelligence. Intuition success in trading isn't about occasional brilliance, it's about repeated, methodical execution. Ultimately, the lesson is that a strategy is only a starting point. It shows you where to go, but it cannot take you there on its own. Discipline is the engine that drives it, turning a plan into action, potential into results, and theory into sustainable profitability. Without discipline, even the smartest system is powerless, and the edge it provides is lost. Traders who understand this build not only strategies but also the habits, patience, and emotional control necessary to realize those strategies in the real world. One of the most important lessons I learned in trading is that the journey to profitability doesn't start with the market, it starts with mastering yourself. Early on, I thought that success depended on uncovering the perfect system, identifying the right indicators, or predicting the market's next move. I spent hours analyzing data, backtesting strategies, and chasing patterns, convinced that if I could just find the right formula, consistent profits would follow. But the truth is, none of that matters if you haven't learned to control your own behavior. Traders who focus on mastering themselves first, rather than obsessing over perfect strategies, gain an advantage that no indicator, model, or system can replicate. Mastering yourself begins with emotional control. The market will always provoke fear, greed, and impatience, and though emotions can sabotage even the most well-designed strategies. Early in my career, I would take trades that fit my plan perfectly only to exit too soon out of fear, or add to losing positions out of hope. Even though my strategy was sound, my lack of self-mastery eroded the advantage I thought I had. Over time, I realized that the only way to make a system work reliably is to develop the ability to stick to it under pressure, to resist impulses, and to respond to the market rationally rather than emotionally. That level of self-control is what separates profitable traders from those who fail. Self-mastery also means developing discipline. Discipline is more than just following rules. It's the ability to execute your plan consistently, regardless of market conditions or your emotional state. It's what allows you to apply risk management consistently, to wait for proper setups, and to resist the temptation to chase short-term gains. Without discipline, even the most brilliant strategy is reduced to a roll of the dice. The traders who succeed understand that mastering themselves, their emotions, habits, and impulses is the foundation upon which any strategy can perform. A trader who cannot execute consistently will never realize the edge their system provides, and over time, that lack of self-mastery compounds into significant losses. Another critical aspect of mastering yourself is patience. The market doesn't owe you quick results, and it will test your ability to wait for the right opportunities. Early in my career, I often felt frustrated when trades didn't produce immediate gains. I would take action prematurely or abandon my approach entirely, thinking that my system wasn't working. What I learned is that patience is a skill, one that is cultivated through repeated practice, and it's essential for long-term success. Traders who master themselves understand that trading is a long-term endeavor, and they accept that consistent execution over time is more valuable than instant gratification. Self-mastery also involves humility. The market will always teach you lessons, often in ways that challenge your ego. No matter how smart, experienced, or talented you are, there will be losses, unexpected moves, and outcomes you cannot control. Accepting this reality and responding without ego is critical. Humility allows you to learn from mistakes, refine your strategy, and avoid repeating errors. It also prevents overconfidence, which can lead to excessive risk-taking and deviations from your plan. A trader who masters themselves sees each loss as information rather than judgment, And that mindset is what allows sustainable growth over time. Finally, mastering yourself creates a compounding advantage. Each time you act with discipline, patience, and emotional control, you strengthen habits that make future execution more reliable. You build resilience to market volatility, clarity in decision-making, and confidence in your system. That foundation allows you to apply strategies effectively, manage risk appropriately, and survive inevitable setbacks. Traders who fail often focus solely on external factors, looking for better systems or faster insights, while ignoring the internal work necessary to execute consistently. Profitable traders know that the greatest edge comes from mastering themselves first, and only then can they harness strategies, tools, and data to achieve real results. One of the most critical lessons I've learned over the years is that sustainable success in trading isn't about occasional brilliance or hitting the right trade at the right time. It's about following a process reliably, managing risk carefully, and adhering to rules consistently, no matter what the market throws at you. Early in my career, I thought that a few big wins would be enough to establish success. I believed that if I could just predict the next big move or find the perfect setup, I would achieve profitability and confidence would follow naturally. But the reality is that the market doesn't reward luck or sporadic genius. It rewards the trader who can execute a disciplined process consistently, who can manage risk without letting emotions interfere, and who can stick to their rules even when it's difficult or uncomfortable. Following a process reliably means creating a structured approach and committing to it no matter how tempting it is to deviate. When I first started, I often abandoned systems midstream or adjusted my rules impulsively because I thought I saw a better opportunity, or because I was frustrated by a temporary loss. Those decisions, small as they seemed, had a compounding effect. Over time, abandoning your process or bending rules under pressure erodes the advantage that any strategy provides. The key is not to look for perfection in the market, but to create consistency in your own behavior. Reliable adherence to a process ensures that your actions reflect your strategy and not your impulses. Risk management is another critical component of sustainable success. Many traders focus solely on finding the most profitable trades, but they neglect the importance of controlling losses and protecting capital. Even the best strategies can fail if risk isn't managed properly. Early on, I learned the hard way that ignoring position sizing, leverage, and stop-loss rules can turn a minor setback into a catastrophic loss. Discipline ensures that risk is always managed consistently, that losses are contained, and that your account can survive periods of volatility. Following your rules doesn't just preserve capital, it allows your edge to compound over time because you're able to stay in the game and continue executing your strategy. Adhering to rules consistently also builds confidence and reduces emotional interference. When you know that you have a system and that you can rely on it, you don't need to make decisions based on fear or greed. You don't have to second-guess every move or feel pressured to react to short-term fluctuations. The confidence that comes from consistent adherence to rules allows you to make rational decisions even in stressful market conditions. It also allows you to evaluate performance objectively because your results reflect your strategy rather than the unpredictability of emotion-driven decisions. Consistency and rule following also provide clarity, which is essential for improvement. When every trade is executed according to a defined process, you can analyze outcomes and learn from them. You can see which parts of your strategy are effective, which need adjustment, and how your risk management is performing. Without consistent adherence to rules, results are muddled by impulsive behavior, and it becomes nearly impossible to identify what works and what doesn't. The traders who succeed understand this and prioritize process over short-term results, knowing that learning and adaptation come from structured execution, not from reacting to every market swing. Sustainable success is also about long-term perspective. The market is unpredictable, and even the best strategies will encounter losses. Traders who focus only on immediate results or isolated wins are often derailed by setbacks. Those who follow a process reliably, manage risk carefully, and adhere to rules consistently are able to endure drawdowns, capitalize on opportunities when they arise, and steadily build their edge over time. Success isn't a single moment. It's a cumulative effect of repeated disciplined actions applied consistently over months and years. Ultimately, Sustainable trading success comes from prioritizing process over outcome, discipline over impulse, and consistency over short-term brilliance. Traders who achieve long-term results understand that the market rewards reliable execution, careful risk management, and adherence to rules more than it rewards clever predictions or sporadic wins. Following a process reliably allows you to survive volatility, compound gains, and turn potential into lasting performance. It transforms a strategy from theory into results and creates the foundation for consistent, enduring profitability.